Hello, my name is Allie Carter, and today I will be analyzing three companies that are traded on the New York Stock Exchange. And the companies that I chose to analyze are Hornbeck, General Mills, and Macy's. Hornbeck is in the service industry of gas and oil. General Mills is a food production company, which they mainly make breakfast cereal. And Macy's is a department store that mainly sells clothes. To analyze these companies, I will be answering three questions. The questions that I'll be answering are, who would I make a 6-month loan to of $1 million, which would be a short-term loan? And the second question would be who I would make a 5-year loan to of $1 million, which would be a long-term loan. And thirdly, it'll be which company would I buy 50% of if I had the chance. To start with, I'm going to do who I could make a 6-month loan to of $1 million. To analyze which one I would make a loan to, I need to look at the liquidity ratios, and the short-term solvency is what they are, and the current ratio, which is current assets over current liabilities, which will give you the least liquid of the liquidity ratios. And looking at the three companies compared over 5 years, because we want to get a little a better grasp on the company, so we look at it for 5 years. Hornbeck is at around 5 throughout the 5 years, and General Mills and Macy's are around 1. And you want your current ratio to be high. So from looking at this chart, we know that Hornbeck would be the best for the current ratio. For the quick ratio, which is your current assets minus your inventory over your current liabilities, which when you're looking at it, again, Hornbeck is around 5 and they're the highest. And General Mills and Macy's are less than 1, but they also are mainly inventory. And because Hornbeck is in the service industry, they don't really have much inventory. And the last ratio for the liquidity ratios is the cash ratio, which is the most liquid of the three, and which is cash over your current liabilities. And looking at it, Hornbeck is still on top. They have around 4 or 3, and then General Mills and Macy's are below 1. And so looking at the ratios put into a graph, we can clearly see that Hornbeck, which is the blue on the graph, is a lot higher than General Mills and Macy's. And you can see that Hornbeck is starting to decrease now, but they're still, even though they're decreasing, are way higher than General Mills and Macy's. So I would make my 6-month loan, my short-term loan, to Hornbeck. So for our second question, it would be who to make a 5-year loan of $1 million to, which is your long-term solvency. So we need to look at how the company will meet their long-term obligations, which would be the equity multiplier and the times interest earned ratio, or the TIR ratio. And for your equity multiplier, that is the measure of the company's financial leverage, which is the use of the debt to acquire additional assets. And we want that to be as low as possible. And looking at it right now, Hornbeck is the lowest at around 2, then it's General Mills at around 3, and then Macy's is around 4. So from looking at just the equity multiplier, Hornbeck looks the best to me. The times interest earned ratio we want to be high, and that is the measurement of the company's ability to honor its debt. So it's if they can pay me back. Looking at it, Hornbeck is around 3, General Mills is below 1, which is not good for me, and then Macy's is around 9. So looking at it in graph form, you can clearly tell that Macy's, which is the gray line, is going up and it's the highest. And General Mills for your tier was kind of high, but then it dropped suddenly. And so it's been decreasing, and Hornbeck is still very low. So even though Hornbeck was the best for the equity multiplier, putting both of the tier and the equity multiplier into consideration, I would have to make my loan of 5 years, so long-term loan of $1 million to Macy's because they seem to be doing the best. And which company would I buy 50% of, which would be who I would be a shareholder of? We need to look at profitability, which would be your ROA and your ROE. And your ROE is the most important, which is how much money the shareholder gets. And your ROA is how efficient management is using its assets to create revenue. And so looking at your ROE right here, you see throughout the 5 years, Hornbeck did have a negative ROE, which is not good for me as a shareholder. And but then it does go up to about 6. And then General Mills, it starts out at about 30, and then it's decreasing to about 19. And Macy's starts out at 16, then increases to 26. So from looking at these numbers right here, Macy's is looking the best. And for your ROA, which is the Hornbeck over 5 years does have a negative again, which is not good. And General Mills, it seems to be about 6% for the 5 years, and Macy's is about 7. So seeing it in a chart form, you can easily distinguish between the companies. You can tell that for your ROE, that Macy's is around the same as General Mills, but Macy's is increasing while General Mills is decreasing. And the same goes for your ROA. But for both of these, you can tell that Hornbeck is way below the other two companies. So we would not want to mess with Hornbeck. And having your ROA broken down into your profit margin, which is how much money the company keeps and puts back into the company. And as the 3 different companies, the profit margin, which one looks the best, is General Mills. But looking at the total asset turnover, which is how the firm uses its assets, we want to be high. And General Mills does not have a high total asset turnover. And so we look at Macy's, and both of theirs seem to be growing. Even though their total asset turnover ratio is not as high, they are growing. We also need to look at the breakdown of the ROE, which is ROA and equity multiplier. And so we have already looked at both of these before, but taking them both into consideration again, we can tell that even though the equity multiplier for Macy's is a little bit higher than General Mills, it makes up with its ROA, which is increasing. So for who I would buy 50% of the company, I would choose Macy's. And also, we need to look at the market value measurement, which would be your price earnings ratio, which basically tells you how people outside the company use your company instead of from your financial statements. And because I'm an investor, I want it to be as high as can be, and so Macy's again leads for that. So for my short-term loan, I would loan to Hornbeck. For my long-term loan, I would loan to Macy's, and for my 50% ownership, I would buy Macy's. Thank you.